Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, we have Carin Pai. She's the Head of Portfolio Management and Head of Equity Strategy at Fiduciary Trust International. Carin, it is great to have you with us. Welcome to Trade Talks.
Thanks so much.
All right, you got it. Let's talk about the current state of the global equities market. What key factors has really been driving the performance for 2023?
Sure, yes. The Fed and the expectations for the Fed in terms of when they might start to cut rates or when they might end the rate hike cycle is definitely front and center. But I think that what has saved markets actually this year so far has been the excitement around AI. Because with the Fed tightening, typically, that would not be positive for equities. However, the equity markets have rallied sort of on the heels and excitement around, what AI might potentially be able to contribute to the economy, but also what they're contributing in terms of corporate profits. So we see this performance reflected in the market this year with a lot of the large cap tech stocks really driving market performance this year and really contributing now about 30% of the weight to the S&P 500. So there's a disproportionate effect from the success of these companies, if you will. And I think that there's been a little bit of a disconnect for most of the year from what these stocks are trading at from a valuation standpoint, given the Fed outlook. So I think that that will continue to be important in terms of the outlook for what the Fed will do. And we do think that valuations will probably reflect the contribution of earnings going forward.
So as we look ahead to 2024, what are the major macroeconomic trends, geopolitical events that could impact the equities markets? And then how should investors be thinking about positioning?
Yes, so I do think that geopolitical events matter in terms of what gets reflected in terms of valuation for equities. And we've already seen valuations come down just with the view that the Fed might raise rates for longer. So that has impacted valuations. But corporate earnings also are going to reaccelerate, or at least the markets expect reacceleration in terms of earnings. So I think that the valuation in equities probably will reflect some investor appetite, which is not quite as strong at this point. We also think that if you look at valuations for equities from an equity risk premium standpoint, which is to suggest that investors really aren't getting compensated to take risks, you've got the equity risk premium that's trading now at below the 10-year average, below the 30-year average, which is hovering around 2%. And that's really a function of the fact that investors can be getting some pretty good yields on bonds right now, with the 10-year bond at around 4.7%, 2-year bonds above 5%. So it's definitely lending some competition. And so I think geopolitical risks sort of weigh into valuations a lot more in that environment.
Right, and you brought up AI before, and we've seen a lot of volatility in the tech sector recently. Do you anticipate this trend to continue into 2024?
We do think that AI will continue to be a driving force in terms of earnings, but we do expect that there would be more competition that might not currently be factored in. I think that companies like Microsoft, Meta, and these companies are probably going to need to compete with one another. And so far, that's not really being discussed or factored in. So I think that, we'll see how things evolve. We'll see who the winners and losers are. I do think that there are winners and losers from AI. I think that companies that will invest and adapt to AI will, and companies that know how to take the data and use it to analyze their business to be more efficient can benefit from AI. However, I do think that the question for next year is really more about corporate profits and earnings as a whole. And I believe that with inflation sort of coming down, that's a positive factor. But there is a little bit of a wild card right now with energy prices potentially lingering higher for longer, and that might add some additional pressure to margins going forward.
How do you see ESG factors influencing equity investing?
So ESG factors, we think actually, it can be done in a very positive and in the right way. If we look at ESG factors as a contributing source of data that allows us to analyze companies, companies that look at ESG considerations as potentially to identify where the risks are to their business, or perhaps even to identify where opportunities are as they evolve their business, can actually be a benefit for their long-term growth outlook. So we do think that companies that are innovative enough to recognize some of the changing trends to their business would actually be a very good thing for investors, regardless of sort of what industry these companies are in. So I think it actually spans across all industries and across the markets.
Any specific sectors that you find opportunistic for 2024?
So for now, we continue to have a more defensive posture. We remain positive on consumer staples. We remain positive on healthcare, in the sense that these companies are generating positive growth, and also they have nice dividend growth stories to them. They're also more economically resilient. So as the economy continues to slow down, these sectors probably should do well. I do think that for most of this year, rising rates has been a little bit of a competition to dividend yielding stocks, but it also means that currently they are undervalued, and so we think that they're attractive. Looking into 2024, there may be some rotation at hand if the if the market looks to the Fed to begin to cut rates, for example. That probably will lead to some rotation in the markets in terms of favoring more value-oriented, more cyclical sectors of the economy, and that actually something like technologies should start to look more attractive, because this is an area that more recently, in the last 6 weeks or so, have corrected, and the Nasdaq is off almost 10% from the highs. So given the growth rate for these stocks, which are typically 2 to 3 times faster than the average for the market, I do think that valuations at some point become much more attractive for them.
All right, Carin, we appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.